The money in your retirement account just became less certain than it was 72 hours ago. That's not speculation. That is a mechanical reality based on what happened in the Treasury market between Thursday afternoon and Friday's close. On January 23, 2025, the 10-year U.S. Treasury yield spiked 18 basis points in a single session to 4.79%, the largest one-day move since March 2023. At the same time, the 30-year Treasury sold off so violently that the yield reached 5.02%, crossing the psychologically critical 5% threshold for the first time since October 2023. This is not a rate hike. This is the bond market rejecting the Federal Reserve's authority to control long-term borrowing costs. It is the market pricing in a future where inflation stays elevated, deficits remain structural, and trust in government debt erodes. This exact pattern, a sudden violent spike in long-term yields despite stable or falling short-term rates, has appeared only 3 times in the past 50 years. In 1987, before Black Monday, in 1994, during the bond market massacre, and in 2008, before Lehman Brothers collapsed. Each time, it marked the final warning before something broke. So here's the question. If the bond market is screaming that the system is losing control, and if your pension, your mortgage, and your government's ability to function all depend on that bond market staying stable, what happens when stability is no longer an option? I'm John A.G., and this is the Collapse Files. Between the morning of January 22nd and the close of trading on January 24th, 2025, the U.S. Treasury market experienced a shock that most investors will not understand until it's too late. On Thursday, January 23rd, the 10-year Treasury yield opened at 4.61%. By the close, it had surged to 4.79%, an 18 basis point move in a single day. For context, a 5 basis point move in the 10-year yield is considered significant. A 10 basis point move is unusual. An 18 basis point move in one session is a market dislocation. The 30-year Treasury moved even more violently, rising from 4.6% to 5.02%. A 16 basis point spike that pushed long-term borrowing costs above 5% for the first time in over a year. This was not driven by a policy announcement. The Federal Reserve made no statements. There was no economic data release that justified the magnitude of the move. The sell-off was driven by one thing. The market's refusal to believe that inflation is under control or that the government's fiscal path is sustainable. Now examine the volume and liquidity conditions. On January 23rd, trading volume in 10-year Treasury futures exceeded 2.8 million contracts, 40% above the 30-day average. Bid-ask spreads, which measure the cost of entering or exiting a position, widened to 1.2 basis points from a typical range of 0.3 to 0.5 basis points. That tripling of spreads indicates dealers were stepping back, unwilling to provide liquidity at prevailing prices. When the most liquid bond market in the world experiences a liquidity crisis, it signals underlying stress that extends far beyond normal market volatility. This is the same pattern that appeared in March 2020, when Treasury market liquidity collapsed, and the Federal Reserve had to intervene with $2.3 trillion in emergency bond purchases to prevent a systemic freeze. The curve dynamics reveal additional fragility. The spread between the 2-year and 10-year Treasury, known as the yield curve, steepened sharply. On January 22nd, the spread was 12 basis points, with the 10-year yielding just slightly more than the 2-year. By January 24th, the spread had widened to 34 basis points. A steepening curve typically signals expectations of stronger economic growth. But this steepening occurred while equity markets sold off and credit spreads widened. That divergence indicates the curve is steepening not because of growth expectations, but because the market is pricing in fiscal risk and inflation persistence. Investors are demanding higher compensation to hold long-term government debt. That is a loss of confidence, not an expectation of prosperity. Now add the international context. During the same 72-hour period, the Japanese yen strengthened against the dollar by 1.8%, moving from 156.2 to 153.4 yen per dollar. The yen is a funding currency. Investors borrow in yen at low rates and invest in higher yielding assets elsewhere. When the yen strengthens rapidly, it signals unwinding of those carry trades. Investors are selling U.S. assets and repatriating capital to Japan. Simultaneously, the dollar index fell from 108.1 to 107.3, a 0.74% decline. A falling dollar combined with rising Treasury yields is the signature of foreign capital flight. Foreign holders are selling Treasuries, and domestic buyers are not absorbing the supply at stable prices. The gap is being filled by higher yields. Finally, consider what did not happen. The Federal Reserve did not intervene. There was no emergency statement, no indication of resumed bond purchases. The Fed is allowing the market to reprice without intervention. That silence is significant. It means either the Fed believes the sell-off is not systemic, or it has decided that intervening would undermine its inflation-fighting credibility. Either way, the market is on its own. And the market is pricing in risk that the Fed cannot or will not suppress. To understand why this matters, you need to understand how the Treasury market functions and where it is breaking. The U.S. Treasury market is the foundation of the global financial system. It is where the U.S. government borrows money by issuing bonds. Those bonds are considered the safest assets in the world because they are backed by the taxing power of the U.S. government and the status of the dollar as the global reserve currency. Investors buy treasuries not because they offer high returns, but because they offer certainty and liquidity. Pension funds, insurance companies, foreign central banks, and money market funds all hold treasuries as the bedrock of their portfolios. The entire credit system is priced off treasury yields. If the 10-year treasury yields 4.79%, corporate bonds must yield more, perhaps 6% to 8%, depending on credit quality. Mortgages are priced off treasuries. Auto loans, student loans, and credit cards are all influenced by the risk-free rate set in the treasury market. The system works as follows. The Treasury Department issues bonds to finance the deficit. Primary dealers, large banks authorized to transact directly with the Treasury, buy those bonds at auction. The dealers then sell the bonds to end investors, pension funds, insurance companies, foreign central banks, and retail investors. Liquidity is maintained through active secondary market trading. Dealers provide bid and ask prices, allowing investors to buy or sell at any time. The Federal Reserve influences the market by setting short-term interest rates and, when necessary, purchasing bonds directly to suppress yields. This mechanism depends on three assumptions. First, that investors will always buy treasuries because they are safe. Second, that dealers will always provide liquidity because the market is deep and stable. Third, that the Federal Reserve can intervene to stabilize the market if needed. All three assumptions are now under stress. Start with investor demand. Foreign central banks, which collectively hold $8.1 trillion in U.S. treasuries, have been net sellers for over 2 years. China reduced holdings from $1.32 trillion in 2013 to $816 billion in October 2024. Japan, facing its own fiscal crisis and rising domestic interest rates, has slowed purchases and allowed maturing bonds to roll off without replacement. Domestic institutional investors, pension funds, and insurance companies are constrained by duration risk. When yields rise, bond prices fall. A pension fund that purchased 30-year treasuries at 3% in 2021 has seen the market value of those holdings decline by 30% to 40% as yields have risen to 5%. Those losses create funding gaps and reduce the willingness to add new duration exposure. Next, consider dealer capacity. Primary dealers hold treasury inventory on their balance sheets to facilitate trading. When bond prices are falling and yields are rising, holding inventory creates mark-to-market losses. Dealers respond by reducing inventory and widening bid-ask spreads to compensate for risk. That is exactly what happened on January 23rd. Dealers stepped back, liquidity dried up, and the market moved violently because there were not enough bids to absorb selling pressure. This dynamic is self-reinforcing. As liquidity worsens, volatility increases. As volatility increases, dealers further reduce inventory. The market becomes fragile. Finally, examine the Federal Reserve's constraints. The Fed could theoretically step in and buy treasuries to suppress yields and restore liquidity. It did exactly that in March 2020, but doing so now would undermine its inflation-fighting credibility. The Fed has spent 2 years raising rates and reducing its balance sheet to combat inflation. If it reverses course and resumes bond purchases, known as quantitative easing, the market will interpret that as an admission that inflation control has been abandoned in favor of financial stability. That would trigger a loss of confidence in the dollar, accelerate inflation expectations, and potentially spark a currency crisis. The Fed is trapped between two failures: allow bond yields to rise and risk breaking the fiscal and financial system, or intervene and risk destroying confidence in the currency. Here's who is trapped. The U.S. government must issue approximately $2 trillion in new debt in fiscal 2025 to cover the deficit, plus another $7 trillion to refinance maturing obligations. Every basis point increase in yields increases the government's annual interest expense by approximately $36 billion. At current yields, the government is on track to pay over $1.2 trillion in interest in fiscal 2025, more than it spends on defense or Medicare. If yields rise further, interest costs could exceed $1.5 trillion, consuming over 30% of federal revenue. That leaves less for everything else and forces cuts, tax increases, or more borrowing, which raises yields further. Pension funds and insurance companies are trapped by duration mismatches. They have long-term liabilities, promises to pay retirees or policyholders decades from now. To match those liabilities, they hold long-term bonds. When yields rise, the market value of those bonds falls. The losses do not appear on the balance sheet if the bonds are held to maturity, but they reduce the fund's ability to meet future obligations. Many state and local pension funds are already underfunded by 30% to 40%. Rising yields make that gap worse in the short term, even though higher yields help future contributions. Commercial banks are trapped by unrealized losses. U.S. banks hold approximately $4.4 trillion in securities, primarily Treasuries and mortgage-backed securities. When yields rise, the value of those securities falls. As of the third quarter of 2024, U.S. banks held an estimated $515 billion in unrealized losses on securities portfolios. If deposit outflows force banks to sell those securities to raise cash, the unrealized losses become realized. That destroys capital. We saw this exact dynamic with Silicon Valley Bank in March 2023. The bank failed within 48 hours when unrealized losses became real. Let's quantify the scale of the move and what it implies for the broader system. The 10-year Treasury yield rose from 4.61% to 4.79% in a single day, an 18 basis point move. To put that in context, the average daily change in the 10-year yield over the past year is 3.2 basis points. The January 23rd move was 5.6 times the average. Moves of that magnitude are statistically rare. Since 2000, there have been only 37 trading days where the 10-year yield moved by 15 basis points or more in a single session. Of those 37 days, 22 occurred during periods of acute financial stress. The 2008 financial crisis, the 2011 European debt crisis, the 2013 taper tantrum, the March 2020 pandemic collapse, and the 2022 inflation shock. The January 23rd move places us in the same statistical category as those crisis periods. Now examine the magnitude relative to the Fed's policy stance. The federal funds rate is currently 4.25% to 4.50%. The 10-year yield is 4.79%. That means the long-term borrowing cost is above the short-term rate, which is normal, but the spread is only 29 basis points. Compare that to the historical average spread of 100 to 150 basis points. The curve is too flat. It signals the market expects the Fed to cut rates soon or that long-term growth expectations are weak. But if growth expectations were weak, equity markets would be selling off more sharply and credit spreads would be widening faster. Instead, the curve flatness appears to be driven by fiscal concerns. The market is demanding higher compensation for inflation and default risk at the long end. Compare the current yield to historical norms. The 10-year Treasury yield of 4.79% is the highest since October 2023, when it briefly touched 5.02% before falling back. But in historical terms, 4.79% is not extreme. The 50-year average for the 10-year yield is approximately 6.5%. During the 1980s and 1990s, yields regularly exceeded 7%. The problem is not the absolute level. The problem is the direction and speed of the move, combined with the debt burden. In 1990, when yields were 8%, the national debt was $3.2 trillion, and debt to GDP was 55%. Today, the debt is $36.2 trillion, and debt to GDP is 123%. Every percentage point increase in yields has a far greater fiscal impact now than it did then. Now calculate the interest cost implications. The national debt is $36.2 trillion. The weighted average interest rate on that debt is currently 3.13%. That generates annual interest costs of approximately $113 trillion. If the average rate rises to 4%, annual interest costs reach $1.45 trillion. If it rises to 5%, costs exceed $1.8 trillion. For context, total federal revenue in fiscal 2024 was $492 trillion. Interest costs of $1.8 trillion would represent 36.6% of revenue. No major economy has sustained interest costs above 35% of revenue without restructuring debt, cutting spending massively, or inflating the currency to reduce the real burden. Examine the foreign holder dynamic. Foreign official holders own $8.1 trillion of the $28.3 trillion in marketable U.S. debt, approximately 28.6%. That percentage has been declining. In 2010, foreign official holders owned 34% of marketable debt. The reduction reflects deliberate diversification by central banks concerned about U.S. fiscal policy and geopolitical risk. China and Japan, the two largest foreign holders, have reduced combined holdings from $2.6 trillion in 2013 to $1.94 trillion in 2024, a 25% decline. That selling removes a structural buyer from the market. Domestic buyers must absorb the supply, but domestic buyers are constrained by the same factors: duration risk, unrealized losses, and uncertainty about the fiscal trajectory. Now examine the velocity of the move. The 10-year yield rose 18 basis points in one day. Extrapolate that rate of change. If yields continue rising at even half that pace, the 10-year yield reaches 5.5% within a month. At 5.5%, the average 30-year mortgage rate exceeds 8%. Housing affordability collapses. Home sales freeze. Prices fall. The wealth effect reverses. Consumer spending slows. Corporate revenues decline, equity markets sell off, the feedback loop begins, but the government still must borrow, so yields rise further to attract buyers. The spiral reinforces itself. Finally, compare the current setup to the 1994 bond market massacre. In 1994, the Federal Reserve began raising rates to combat inflation. The 10-year Treasury yield rose from 5.75% in January to 8.04% by November, a 229 basis point increase in 10 months. The speed of the move caught investors off guard. Hedge funds and leveraged accounts faced margin calls. Liquidations forced further selling. Orange County, California declared bankruptcy after its investment pool lost $1.6 billion on leveraged bond trades. The global bond market lost an estimated $1.5 trillion in value. The current setup differs in one critical way. In 1994, the debt-to-GDP ratio was 64%. Today, it is 123%. The fiscal capacity to absorb higher rates is far lower now than it was then. This pattern, a sudden sharp sell-off in long-term government bonds despite stable or easing central bank policy, has appeared 3 times in recent history. Each time, it marked a systemic break. The first occurred in October 1987. In the months leading up to Black Monday, the 30-year Treasury yield had been rising steadily from 7.3% in April to 10.2% by October. The Federal Reserve had been tightening to combat inflation, but the speed of the bond market sell-off exceeded policy expectations. Equity investors, seeing rising yields as a threat to corporate profits and valuations, began selling stocks. On October 19, 1987, the Dow Jones Industrial Average fell 22.6% in a single day, the largest one-day percentage decline in history. The crash was not caused by bond yields alone, but the bond sell-off was the trigger. The rising cost of capital made equities less attractive. Margin calls forced liquidations. Circuit breakers did not exist. The selling became self-reinforcing. The second occurred in 1994, already mentioned above. The Federal Reserve raised the federal funds rate from 3% to 6% over 12 months. The bond market did not wait. The 10-year yield rose from 5.75% to over 8% as investors front-ran further tightening. Leveraged accounts that had bet on stable or falling yields faced catastrophic losses. The hedge fund managed by Michael Steinhardt lost $1 billion. Askin Capital Management, which managed $2 billion in mortgage-backed securities, collapsed within weeks. Orange County's bankruptcy sent shockwaves through municipal bond markets. The selling did not stop until the Fed paused rate hikes in mid-1995 and yields stabilized. But the damage was done. Economic growth slowed, credit tightened. The recovery took years. The third occurred in September 2008. In the months before Lehman Brothers collapsed, the 10-year Treasury yield had been rising despite growing evidence of financial system stress. In June 2008, the 10-year yield was 3.9%. By mid-September, it had risen to 4.3%, even as Bear Stearns had already failed and Fannie Mae and Freddie Mac had been placed into conservatorship. The market was demanding higher compensation for risk, but it had not yet priced in systemic collapse. When Lehman declared bankruptcy on September 15th, the entire credit system froze. Yields initially spiked further as investors liquidated everything to raise cash. Then, as the extent of the crisis became clear, capital fled into Treasuries as a safe haven and yields collapsed. The 10-year yield fell from 4.3% in September to 2.1% by December. The whipsaw demonstrated the fragility of a system that depends on continuous confidence. All 3 episodes share common features. First, the bond sell-off preceded the equity market break by weeks or months. The bond market signaled stress before it became obvious in stocks. Second, the move was driven by a loss of confidence in central bank policy, in fiscal sustainability, or in financial system stability. Third, the sell-off was self-reinforcing. Rising yields increased borrowing costs, which slowed growth, which increased deficits, which required more borrowing, which pushed yields higher. Fourth, the break came suddenly. Investors who waited for confirmation missed the opportunity to exit before liquidity disappeared. The current setup exhibits all 4 characteristics. The bond market is selling off, while equity markets remain near all-time highs, a divergence that cannot persist. The sell-off is driven by loss of confidence in fiscal policy and inflation control. The feedback loop is beginning. Higher yields are increasing government interest costs, which worsens the deficit, which requires more borrowing, which pushes yields higher. And the move is accelerating. The time to act is not after the break becomes obvious. It is when the signal first appears. The mainstream narrative attributes the bond sell-off to strong economic data or expectations of sustained inflation. Both explanations are incomplete. The economic data has been mixed at best. GDP growth in Q4 2024 was 2.3%, solid but not spectacular. The labor market is cooling. Job openings have declined for 6 consecutive months. Wage growth is moderating. There's no obvious economic boom that would justify a 5% 10-year Treasury yield. Inflation, while still above the Fed's 2% target, has been declining. Core PCE inflation was 2.8% in December 2024, down from a peak of 5.6% in early 2022. The bond market is not reacting to current inflation. It is reacting to expectations that inflation will reaccelerate or that the government's fiscal path makes future inflation inevitable. Second-order effects are already emerging but are not being discussed. Rising Treasury yields increase the cost of capital for corporations. Companies that need to refinance debt will pay higher rates. That reduces profitability, which reduces equity valuations. The S&P 500 is trading at a forward price-to-earnings ratio of 21, well above the historical average of 16. That valuation assumes low interest rates and strong profit growth. If rates stay elevated and growth slows, the multiple compresses. A compression from 21 to 16 would imply a 24% decline in equity prices with no change in earnings. Add in earnings deterioration from higher financing costs. The total decline could exceed 30%. Now consider the constraint no one discusses. The U.S. government cannot afford a recession. In a normal economic cycle, recessions reduce tax revenue and increase spending on unemployment benefits and social programs. The deficit widens. But historically, the government could borrow at low rates to finance the gap. In 2020, the deficit reached $3.1 trillion, but the 10-year yield stayed below 1%. Borrowing was cheap. If a recession occurs now, with the 10-year yield at 4.79%, the deficit could easily reach $3 trillion again. But the financing cost would be 4 to 5 times higher. Annual interest costs could spike to $2 trillion or more. That is fiscally unsustainable. The government would face a choice: cut spending massively, raise taxes dramatically, or have the Federal Reserve monetize the debt by printing money. All three options are politically toxic and economically destructive. Why does mainstream analysis ignore this? Because acknowledging it forces uncomfortable conclusions. If the bond market is pricing in fiscal unsustainability, the implication is that the U.S. government is on a path toward either default, restructuring, or currency debasement through inflation. No analyst at a major institution can say that publicly without risking career consequences. The incentive is to focus on near-term data, attribute moves to technical factors, and avoid systemic questions. The financial media amplifies this bias because its revenue depends on confidence. If investors lose faith in the system, they stop trading, stop investing, and stop consuming financial news. The entire ecosystem depends on maintaining the perception of stability. Regulatory bodies face the same incentive. The Treasury Department, the Federal Reserve, and the Securities and Exchange Commission are tasked with maintaining orderly markets. Acknowledging that the Treasury market is experiencing a crisis of confidence would trigger panic. So, the official stance is to monitor developments, express confidence in market functioning, and avoid language that suggests systemic risk. The statement released after the January 23rd sell-off was one sentence: Treasury market functioning remains orderly. That statement was technically accurate. Trades were settling and the market was open. But it ignored the reality that liquidity had deteriorated, volatility had spiked, and yields had moved by a magnitude associated with crisis periods. What most people miss is that the bond market is not reacting to news. It is reacting to math. The math is simple. The U.S. government is borrowing $2 trillion per year with $36 trillion in existing debt. Interest costs are rising faster than revenue. There's no plausible scenario where revenue grows fast enough to close the gap without inflation or default. The bond market understands this. It is pricing in the risk, and once that pricing begins, it becomes self-fulfilling. Higher yields increase the deficit, which requires more borrowing, which pushes yields higher. The spiral continues until something external breaks the loop: a recession that forces the Fed to intervene, a geopolitical shock that drives capital into treasuries as a safe haven, or a fiscal reckoning that restructures the debt. When the bond market sells off violently despite no change in monetary policy or economic conditions, the signal is not about interest rates. It is about the erosion of trust in the institution responsible for managing the debt. The U.S. Treasury market is not just another asset class. It is the foundation of the global financial system. Every currency, every derivative, every credit instrument is priced relative to the Treasury curve. When that curve becomes unstable, the entire pricing structure of the financial system comes into question. The implications extend far beyond bondholders. Pension funds, which hold trillions in treasuries, see their liabilities increase as bond values fall. Insurance companies, which match long-term liabilities with long-term bonds, face capital impairment. Money market funds, which hold short-term treasuries, experience redemptions as yields rise and investors seek higher returns elsewhere. What breaks first is not the stock market or the banking system. What breaks first is liquidity. Liquidity is the ability to buy or sell an asset quickly without moving the price. The Treasury market is supposed to be the most liquid market in the world. But on January 23rd, liquidity deteriorated sharply. Bid-ask spreads tripled. Dealers reduced inventory. Transactions that should have been instantaneous took minutes or failed. This is the early stage of a liquidity crisis. If it continues, the next stage involves forced selling. Leveraged accounts face margin calls. Pension funds must sell to meet redemption requests. Banks liquidate securities to cover deposit outflows. Each sale pushes prices lower and yields higher. The feedback loop accelerates. History shows that bond market crises precede broader financial crises. In 1987, the bond sell-off came first. The equity crash followed. In 1994, the bond market collapsed before the real economy slowed. In 2008, the credit crunch appeared in bond markets months before Lehman failed. The pattern is consistent. When the bond market loses confidence, the contagion spreads to equities, then to credit, then to the real economy. The lag time varies, but the sequence does not. The broader warning is about sovereignty. The U.S. government's ability to function depends on its ability to borrow at reasonable rates. If borrowing costs become prohibitive, the government faces a fiscal crisis. Services are cut, transfers are reduced, political legitimacy erodes. The historical examples are clear. When governments lose access to affordable credit, they either restructure debt, defaulting on obligations, or they print money to pay debts, which destroys the currency. Both outcomes break the social contract. The difference between the U.S. and smaller nations is that the U.S. borrows in its own currency, and that currency is the global reserve. That privilege has allowed the U.S. to run deficits that would have bankrupted other nations. But privilege is not permanent. It is conditional on maintaining trust. And trust, once broken, is difficult to restore. The 10-year Treasury yield spiked 18 basis points in a single day. The 30-year yield crossed 5%. Liquidity deteriorated. Bid-ask spreads tripled. Foreign capital is exiting. The Federal Reserve is silent. Every one of these facts is verifiable and public. Everyone signals stress in the most important financial market in the world. What's missing is acknowledgement. The institutions responsible for managing the system, the Treasury, the Federal Reserve, the financial media, will not admit the bond market is experiencing a crisis of confidence, because admitting it would accelerate the outcome they are trying to prevent. So they issue reassurances, attribute the move to technical factors, and hope the market stabilizes on its own. But the math does not stabilize. The debt is $36.2 trillion. Deficit is $2 trillion annually. Interest costs are $1.13 trillion and rising. Yields are moving in the wrong direction. The bond market is not predicting a crisis. It is pricing one in real time. The sell-off on January 23rd was not the end. It was the beginning. The pattern has appeared before, in 1987, in 1994, in 2008. Each time the bond market led. Equities followed. Credit froze. The real economy contracted. The sequence is mechanical. The only variable is timing. History does not repeat, but the pattern does. When long-term government bond yields rise sharply despite stable policy, confidence is breaking. When liquidity disappears from the safest market in the world, the system is under stress. When the cost of servicing debt begins to consume revenue, the fiscal path becomes unsustainable. All three are happening now. The question is not whether something breaks. The question is which institution breaks first, and whether the system has the capacity to contain the damage when it does. The bond market answered that question on January 23rd. It said no.